Hosting this webcast with 91, and in particular Malcolm Charles from 91. We're going to be talking the two actively managed ETFs that they listed on Wednesday last week, the 12th. Both of them are income focused, a local and an offshore one, but obviously listed on the JSE, so the offshore one backends into Rand. We're going to talk a little bit big picture. We'll go into details. We've certainly got some time for questions. So if you've got questions, you can drop those into the Q&A box. Malcolm, appreciate, and just a quick point before we go further. We've had a tech issue, so no video, but you don't need to see our smiling faces. You just need to hear the thoughts. Malcolm, appreciate the time this morning. And we sit as a weird place as a South African at this sort of Monday morning. We've had a credit upgrades from Standard & Poor's Global Rating. We had a fairly good medium-term budget policy statement from the minister. We've had CPI targets downgraded. We're off the grey listing. There's a lot of boxes to tick to say, hey, things are really looking up.
Yes, Simon. I mean, it really is a fantastic time to be a South African, and it's an even better time to be a bond manager. The asset class has done fantastically well this year and had a phenomenal boost just in the month of November, and we're only halfway through.
And I want to drill into that because bonds are sort of the inverse. It's the yield up, price down, or in this case, yield down, price up. What we've seen is yields on our bonds, and we could just take a 10-year as an example, are improving. They're coming lower. That means that the value of the bonds go up.
Absolutely. So, yeah, for many years now, we've had a lot of risk premium price, and I suppose quite rightly so, with load shedding and state capture and just a dysfunctional government. And you know, the market always takes a while to sort of come around and reprice accordingly. And you know, the GNU is working a little bit better. The reforms that we've had from Operation Vulindlela are starting to kick in. We've seen surprises to the upside in growth. That's not something I've said in 10 years.
Yeah.
And quite rightly, S&P on Friday acknowledged that, and acknowledged that National Treasury have done a fantastic job in consolidating our debt. They haven't actually got our debt down yet, so you know, it's the first step in a big improvement. But they're happy to acknowledge that. And what's happened is that the market, as you said, the yields have fallen, which means the price has gone up, and the All Bond Index, as we sit here today, has returned 20% for investors in 2025.
That's actually, I mean, that is if you were talking equity, it would be a staggering number. It's an even more staggering number for bonds. I want to drill into lots of what you're talking about, but let's quickly just touch on, you talk around the Vulindlela and that sort of how that's been working. And I suspect it was very slow at first. And then, I mean, you know, Eskom, I mean, load shedding is by and large over. Transnet, we're seeing some green shoots. The trends are all kind of pointing in the right direction, and many of us would say, you know, there's a lot still to do. There absolutely is, but it's those trends which are so important, because to turn around giant state-owned enterprises is a mission.
No, absolutely, and I, as a South African, the person we've got to be most grateful is a guy called Rudy Dex. He heads up Operation Vulindlela in the presidency. He's a civil servant that is committed to the country. And I joke that if anyone needs, you know, a blue light brigade, it's him, because he really has. So he drove the Eskom turnaround, and got the whole structure adopted by cabinet, where they allowed private enterprise to get involved with energy generation, with the renewables, and that's all gone very, very well. We have had estimated about 400 billion rand of private money invested into renewable projects in South Africa so far, and that number is only growing. And that's why, as you said, you know, load shedding, you know, 2-3 years ago when I mentioned it in webinars that load shedding would come to an end, people thought I was smoking the newly legalized cannabis. But yeah, it's been fantastic, and he's now moved onto Transnet. And you know, once you've done one big state-owned enterprise, you sort of learn from your mistakes. So they've been a little bit more agile, a little bit quicker in turning Transnet around. And we started to see the fruits of that. We've seen an uptick in rail freight. Our harbors are performing a lot better. We got all our we got 20% more citrus out of this country in May and June, which was very important to do before the tariffs kicked in. And that was because they've invested in the ports, they've put more cranes in, they've changed their shift system from 2 shifts to 3 shifts. So you've got longer working hours, etc. So it's just, once again, public sector working very, very well with the private sector, and the country's benefiting. So that's why we're going to have growth north of 1% this year, when we've had 0.5%, for the previous year. So that's how you start. You start, and yes, one's not enough yet, but it is double what we had last year. So let's start with doubling it, and then we'll move on from there.
Yeah, I take your point. I mean, one is not exciting, but it is in our world. We will take it. I want to touch on some of the medium-term budget policy statement from the minister on Wednesday afternoon. What's the debt story? Because that really is the big issue. My understanding is it's still edging higher, but he's not expecting it to get much higher and then start to sort of trend down.
So since about 2010, when Zuma really opened the taps on spending and the state capture, we've seen debt spiral basically almost out of control. And during COVID, it was estimated, if we were on the current path, it was going to get north of 100%. Luckily, Tito Mboweni stepped in and said, no, this is unsustainable. We'll be downgraded to like levels that no one will want to even put a cent into South Africa. And Enoch Godongwana has continued that trend, and they've now so what they were doing is every single budget the finance minister would stand up and go, over the next 3 years we are going to stabilize debt. So it was always in 3 years time, and it was like a rolling 3 years, which, as we all know, is not sustainable. Now they stabilize in debt in 2025-26 financial year. So we top out at about 77% debt to GDP, which is way below the 100% that we were heading towards. And we, from next fiscal year, the number is lower. And the way that they've done that is, first and foremostly, we've got a primary surplus. We've had a primary surplus for the last 2 years. So that's your surplus, excluding your interest bill. So that's how you start. You start just consolidating your spending. And that we had 0.5% primary surplus for 2 years, and they now forecast to be about 1% this year. So once again, that's also increasing, which is a very good thing. And everyone goes, oh no, that's an easy thing to do. An interesting fact is that there are only 5 countries in the world with primary surpluses, and we one of those. So it's quite nice in one. It's like the rugby, I suppose, where you're in the top 5 of the world. It's quite special that we are up there.
Absolutely, and it makes that wiggle room so much easier. And it doesn't mean that our debt goes away, but it means that the trajectory is going in the right direction. It changed to the inflation target. Now it was back in was it July when the governor talked around anchoring, and he was careful with his choice of words. They were going to anchor at 3%. We've now got the minister on board. The official inflation target is 3%, and he says a 1% band either way to give us some wiggle room. That ultimately is also going to, and again, it's not a switch, it doesn't happen overnight, but that'll help our debt cost as well, not only for the sovereign, but for the individuals as well. Prime rates as well will be ultimately lower as a result of that.
No, completely. I mean, so what it does is it just brings down inflation expectations. That's what inflation targets are all about. It's about changing your mindset of what you expect. So it's what people expect for increases, for their rates and taxes, for your medical aids, for your salary increases, all those sorts. And as the mindset changes, guess what? Inflation starts coming down. And the minute that happens, it means SARB, the Reserve Bank, can anchor rates a little bit lower. It means you and I can access home loans a little bit cheaper. Businesses can access cash a little bit cheaper, which means it stimulates the economy and ultimately starts creating jobs. And as you mentioned, the big one is government debt becomes or comes out at a much lower rate, and it's a lot easier to then stabilize the fiscal situation and then all in all, the whole country benefits. And it's been a progression. I've seen a lot of criticism about this game. Are they mad? But back in the early 2000s when they introduced it, we had double-digit inflation. I lived through that where you had 13, 14% inflation, and then they announced the 3 to 6%, and we all laughed. We said, it'll never happen. Are you mad? And Trevor Manuel, I'll never forget, he was the finance minister at the time, stood up and he said, I predict that a government bond, which is currently we're trading at 15%, will trade below 10%, and inflation will get below 10%. And we went, never. Well, 2-3 years later, that's exactly what happened. And that's what happened. So this is now the next step. So we got the first level down, and now we're anchoring it closer to our trading partners, which means the currency will be more stable. Because if your interest rates are lower and very similar to your trading partners, your currency does not need to adapt for that the interest rate differentials, because that's how markets work. So all in all, it should lead to a more stable currency, easier funding, or lower rates for funding, whether you're an individual, a business, or government, and therefore savings, and that will stimulate growth across the economy.
Yeah, I bought my first house in 1998. Prime 26%.
It makes the eyes water when you.
Yeah, I mean, I sympathize with people who were buying when it was what? Where did we get to? 11.75. But guys, it was 26, and it fell quick. I mean, make no mistake, it got below 20 in a hurry. But still, on that, we've got an MPC meeting on November. Is there any chance of another rate cut from MPC, or are they going to hold?
No, I think there's a very good chance. So at the last meeting, it was a very close call with the voting of the governors. We think there's a 60, 65, maybe even 70% chance of a rate cut.
Okay.
In the November meeting, I'm leaning towards. I think they will. Inflation's been under control. It's in the streets. It's going to average 3.3% this year. It's going to average about 3.4, maybe even 3.5 around there next year. So the outlook is positive. It's looking very good. If we don't get one in November, I think you can almost guarantee that they will go in January. But the more I look at it, the fact that we had a very good budget, we had a budget that the Reserve Bank has been calling for many, many years. So finally they got delivered a very conservative budget, which then allows them to actually be a little bit more stimulatory on the monetary policy. So when fiscal and monetary policy work well like this together, I think we can expect a much more exciting outlook for the economy.
Quickly, before we head on to the two actively managed ETFs, the Standard & Poor's Global Rating upgrade on Friday was in of itself a monumentous event. They also then said to us that so we are still not investment grade. We're 2 notches below. For the folks who are saying we're still junk, we are still junk. But they also gave us a positive outlook, which means that they can, I mean, technically, and I'm not saying they will, that they could push us another notch higher at the next meeting. It's that trend, and now we need Moody's and Fitch to come to the party. And I think one of them is in December, and I can't remember. I think
it's Moody's. Moody's make their announcement in December. So so it's a very good, as you mentioned in your in the intro, is we off the grey list as well. So that was sort of the first little box that needed to be ticked. Now we've got rating agencies sitting up, taking notice, and this is in an environment where a country like France 2 weeks ago was actually downgraded. So we are in a world that's a little bit mad at the moment. We are actually doing the right thing and behaving responsibly with our fiscus and our money. So it's very encouraging to see. And guess what? The foreign investors have noticed. They've been buying our equities for the first time in a long, long time. And for the last three months or so, they've been buying our bonds. So it hasn't gone unnoticed that we are actually doing the right things. And, that positive outlook from S&P was the real surprise. We all thought there was a reasonable chance of an upgrade from S&P. And normally what happens, when you have upgrade, they put you on neutral and sort of watch you for 6 months to a year before they put you on positive.
Mm-hmm.
But it just shows how impressed that they are with the budget that was delivered last week.
Yeah, absolutely. I thought there was an easy over 50% chance we'd get the rating upgrade, but I did not expect the positive. I thought they would sort of stick us on neutral. Let's touch on the funds. There's the 91 Diversified Income Fund. The code is 91DINC, which is 91 Domestic Income. These are actively managed ETFs as opposed to passive. The idea here, Malcolm, really is around generating yield, but also a capital preservation in the process. Because if I'm looking for income, I'm looking for that lower risk and the income coming with it.
No, absolutely. So as we always say, the hints in the name, it's an income fund. First and foremostly, we make sure that we sweat every bit of income that we can find. So we look at the market and make sure that there's no lazy cash in the portfolio, and we try and maximize the yield. But we've got this mantra: participate and protect for both these funds, and we've been doing this for next year is 20 years that we've been managing the fund this way. And what we mean by that is that when the market does very well and the bond market, like now, we want to participate. We won't give you the same return as the bond market, but we want some of that capital gain, and hence you get an enhancement and a nice tick up way over cash. And then when the market has wobbles, which, as we all know, we live in South Africa, which is an emerging market, we have a couple of those. That is where this fund really steps in, and we want to protect, and we want to give you cash-like returns in that sort of environment. And the way we do that is we always have a little bit of FX in the portfolio that gives us a buffer against South African volatility. We'll buy options in the portfolio to protect us, like a Nene Gate and COVID and things like that, where it's just like a bit of insurance in the portfolio, where an unpredictable event happens. Guess what? The fund gets protected, and you don't lose your shirt. So it's conservative in that way, but it uses multiple asset classes. It takes a bit of bonds, a little bit of credit, property, across all the income assets that we can invest in. We make sure that the risk and the return are correct in the portfolio at any one time.
And you make a good point there. This is a new actively managed ETF listed on Wednesday, as I said, but this is not a new fund. 91 has been running this as a unit trust, as a collective investment scheme, as you say, 20 years.
Absolutely. So it's tried and tested. It has consistently outperformed cash. And it's so important. I always find it quite sad how people sit in very lazy cash portfolios. And if you adjust for inflation and sometimes even for tax, you really just do not. You actually go backwards as an investor. And just by taking a little bit of extra sort of active exposure in a fund like the Diversified Income Fund and the ETF, you can that extra that you earn every single year, and you compound that over 5 years, 10 years, 20 years, it becomes quite a big number.
That's actually a really great point, because I'm thinking here, an income fund, this is particularly for folks who are looking for income, traditionally would be perhaps retirees. But there is also that component where, as a sort of balanced portfolio, more broadly, you would have cash, or in this case, the sort of near cash, and this fills that role as well. I always have some cash holding in my portfolio. I'm better off putting it in here. There was a time a little while ago when we were getting better rates at the banks, but I imagine at that point you were getting better yields. Cash is a drag on return.
Absolutely, and especially now that we targeting 3%, as we discussed earlier. The Reserve Bank is going to keep rates a lot lower. So you're going to be a very low yield in a cash or a call account or something like that. So you've got to look at something that has got the levers to actually take advantage of the restructuring market, etc., so that you can get some of that participation and hence keep comfortably ahead of inflation and other cash accounts.
Yeah, yeah. The Global Diversified Income Fund, also an actively managed ETF. Here, the code is 91GINC, so 91 Global Income. Welcome. The trick here, of course, is you get a lower yield because, well, that's what happens in developed markets. I mean, we're really excited with a 10-year below 9, but I think, if that happened in developed markets, we've got a crisis of epic proportions happening. We get lower yields. Of course, we get the currency here as well.
Yeah, so but it's the same principle. So we launched this fund on the back of our experience in South Africa, and also when rates sort of normalize. So you say the yield is low, it's around 5%, but remember, their cash rates are around 3, and their bond yields are 4%. So it's once again, it's the same principle. It's looking at the different asset classes, and the beauty of this fund, it is a very conservative fund. It only invests in investment grade credit, and so therefore, you don't get any South African bonds or anything like that in the fund because they don't quite crack it. So it's predominantly it's priced in dollars, but with what's going on in the US at the moment, we've actually diversified a little bit out of dollars. We've gone into Europe, we've gone into Australia, we've gone into New Zealand. Look a little bit more scope to cut rates and hence get a little bit of capital gain out there. So we actually, while diversified income, we are the local fund, we are very constructive, and we're a little bit overweight our duration. We're a little bit overweight the listed properties. So we still think we can participate a little bit more. We've gone a little bit more defensive in this fund, and we're slightly underweight duration. And we've got a very conservative allocation to good quality credit to give us that extra yield. And as I said, you're earning around 5% in dollars, which is is quite a healthy return in that very low yield environment.
Yeah, no, absolutely, and that's just it. I mean, I think with the 10 years, the US 10 years 4.1, so 5% is a chunky number. And I know you're not the ETF expert, but ETFs typically passive. The beauty of these is that they are active, so that you can, as you say, a little less dollars perhaps, or a little less US. You've got that flexibility within both funds to hunt out what's going to work and deliver that return.
Absolutely. You want to know that their people are, they're sweating it out to make sure that if there's a wobble, you get like protection against that wobble. But equally, when you have the stars aligning like they have in South Africa and one or two other developed countries out there, you're taking advantage of that, and if the guys want to start cutting rates in Australia and New Zealand, you want to benefit from the capital uptick in those countries. So every single day we myself and the team here in Cape Town, and we've got colleagues in London, so we use all that collective sort of skill and wisdom to look for opportunities to make sure that both these funds participate as much as possible to enhance the yield and enhance the capital return, but equally have got protection strategies to protect against if some crazy global event happens.
Yeah, absolutely. Folks, if you've got questions, you're welcome to drop them in. A couple are coming. Will these be eligible for tax-free accounts? The answer is yep, they are absolutely. Whoever your tax-free provider can then do that. And Malcolm, a question came in, which is, this is an offshore fund, but in ZAR, and that's it. It's going to trade on the JSE in rands, but you're switching those rands into the foreign currency. So I get the currency impact as well as the yield.
Yeah, so yeah, exactly. So it's priced in rand, but it's when we construct the portfolio, we invest it in dollar assets and everything like that, and then it gets converted back and converted back into the rands.
A question coming through, which is more back to sort of the big picture. Infrastructure spend is low, industrialization is low, etc. And it comes to you mentioned Malcolm, 1% GDP. it's still a low number. It's a much better number. This is a process that is going to play out over years. It's not even a 2026 process. This really is going to take, I don't know, 2-3 years, perhaps even more, as we get back to investment grade, as we get the GDP growth and we start sort of industrializing and the like. This isn't an overnight story by any stretch.
No, it isn't. But I mean, we've got the right structures in place now. The country was almost destroyed. We didn't realize that, but we all knew it was bad. We didn't realize how broken it was. So we've been rebuilding structures and institutions and everything like that. And the two biggies were obviously Eskom and Transnet. Sanrail is doing a good job, but you can't drive on a road in South Africa in the main roads without seeing roadworks and stop goes, which is fantastic, because that is fixing a bit of a broken story. So it's what we are seeing is good spending, which will accelerate and will start, gaining momentum. So the growth forecast for next year is up to like 1.5, 1.6. The following year, we start getting close to 2%. And if Operation Vulindlela continues this momentum, the Bureau of Economic Research in Stellenbosch estimate that we will be around 3.5% annual growth in 3 to 4 years' time. So that is something that we have not seen since the early 2000s. The structures are in place, the foundation is now in place. It's up to private companies and a continuation of the government support for us to make sure that we do take it from this 1% up to the 3.5% that we need.
Absolutely, and to be clear, we've done those numbers before under the 3Ms, Mbeki, Emmanuel, and Mbweni when he was at the Reserve Bank. We were doing a little over 5 at a point. Question coming through: is this available on Shift? Yeah, it's on Shift. If it's a stockbroker, it's available because it is JSE traded, and that is the beauty of actively managed ETFs. Miles is asking time period for investment in these income funds, please. I mean, in short version, Malcolm. I mean, because on the JSE, I could literally buy it in the morning and sell it in the evening. Kids, don't try that at home. That is not the design feature of it. But it's really, I mean, this is the sort of thing I could put into my fund and leave forever, or I could have, maybe I've got an event, maybe I'm getting married at the end of next year and I need to park cash somewhere. It's as per the user need, and it's got that flexibility.
Absolutely. I mean, you quite rightly say, you can trade on a daily basis, but that is not the aim. It is not your current account. It is aimed at anyone if you've got a holiday that you plan in, as you said, an event, you want to save up for a car, 6 to 12 month horizon, then you want to go into a fund like this, because it'll give you it aims to give you a better return than like sitting in lazy call. So it really is. It needs time to make the opportunity for the event to happen, because as we've seen this year, the first 3, 4, 5 months even of this year were terrible.
Yeah.
There was uncertainty, thanks to Mr. Trump and Liberation Day and all those things. The market had a wobble, and the bond market was actually in negative territory. But we were confident that we were on the right track, and we stuck through it, and we added risk to the portfolio. As we got more confident in our view that we would have rate cuts, that we'd have a better budget, and the economy would have improved, and the fund has rewarded accordingly, because as we mentioned, bonds have done 20%, and the fund has shared in some of that upside.
Tranisha's given me more accurate details in terms of the total expense ratio, 0.5% ex-VAT, so around 0.53% including VAT. The one question is, if our inflation targets are around 3.5%, does that mean if we've got effectively, let me rephrase that question. Although the minister said 3%, is it fair to say that our inflation target is effectively 2 to 4%, because he did say 1% either side, which means 3.4, 3.5 current inflation won't stress him?
Yes, no, absolutely. So it's a slight change. So when you have the band, you give the flexibility to the Reserve Bank to target almost where they want. So if you think about it, Tito Mboweni and Jill Marcus typically target at 5.5%, and they were within the band. Then Lisette Khanyago came in and he said, no, I think it's time for a step change. And he started targeting 4.5%.
Mm-hmm.
And it took about 2.5 years for the market to cotton onto that and expectation change. And then he said, as you said in the intro, he wants to start anchoring it around 3. So all of that was actually within his mandate.
Yeah.
I think that what this does is it gives the clarity now that there's no interpretation. 3 is your target, but if you're at 3.5 and you think it's only going to be there for 6-7 months, you don't have to take strict, you don't have to hike rates to bring it down. If you think there's a blip in the oil price or something like that that's caused it, or food prices due to some like foot and mouth disease or something like that, you don't have to hike rates. And equally, if there's a collapse in the oil price and you go to 2.5%, you can actually stay and hold if you think it's short-term in nature. So it just gives the clarity to the Reserve Bank of do they need to take action or not.
Yeah.
But because you've got that margin.
Yeah, it is. It gives them that little bit of flexibility rather than that definite number. So the domestic is playing quarterly, Tanisha says, and the global will roll up. Ladies and gents, we're going to leave it there. I don't see any more questions coming through. As I said, both are available and all stockbrokers. Both are available within tax-free accounts. I like the products. Back in the day, I can remember saying that bonds were boring, and maybe I was just younger. Maybe it's because I'm getting older. But I find some space for them, particularly when markets get a little bit wobbly and a little bit uncertainty. That sort of near cash. I don't want cash. I want the near cash. Actually does what it says on the sticker. Ladies and gents, thank you very much for your time. Malcolm Charles, 91. Really appreciate the time this morning.
Thanks very much, everyone.
Cheers all. We will leave it there. As I said, no video, apologies for that. But really, you didn't need to see our smiley faces. Everyone have a great day further. As always, look after yourself. And if you can, look after somebody else as well. Cheers all.